if the rest of the world is doing better, and that's the reason the dollar can't get a bid, why should I sit at home in the United States when I can get some nicer FX, swim naked over in Europe, get the boost from a weaker dollar, and get the exposure elsewhere in terms of risk? Is that what you should be doing, Mike?
You know, I mean, you could argue that the U.S. growth has been good, but our potential growth rate is probably 2% or just below. So we're running a little bit hot versus potential. Some of these other places, like Japan and Europe, are arguably running much hotter than their potential, right? So it's a relative game, which is one reason the dollar is a little bit weaker relative to some of those foreign currencies.
Well, let's talk about what you've been doing, Mike. You're adding exposure to places like Greece. How much risk are you taking in a place like Greece, and where else are you looking on the periphery of Europe?
Yeah, I mean, you have to take risk to make money in these markets, right? Risk-free assets are really low. Even high-quality corporate bonds and high-yield bonds have really tight spreads. So you have to look for improving credit stories where you're getting some value. So Europe and peripheral Europe is one of those places. And emerging markets is one of those places where, like we said, U.S. is growing well, Europe and Japan are growing well, but the emerging markets, some of these guys are coming out of deep recessions, right? And they actually look at it, and their central banks are cutting rates in certain cases.
Well, let's talk about peripheral Europe for a moment. I just want to sit there for a little bit. I've been asking for a long time how much longer peripheral bonds can trade like credits. You keep referring to them as credits because they've traded like credits. But at some point, the ECB steps away and they stop trading like credits and they start trading like sovereigns. You see high growth, I'm going to see high yields. You see it from Bunds and elsewhere. Are we going to get that anytime soon?
It's possible, right? They actually have something in Europe that we don't have in the U.S. It's called fiscal discipline, right? They actually have a rules-based system. In 5 or 10 years from now...
If they stick to it, Mike.
If they stick to it, in 5 or 10 years from now, there's a really good chance that their fiscal situation in Europe as a whole, and even in some of the peripheral countries, look better than the fiscal situation in the U.S.
And that's part of the dollar story, too.
Yeah, absolutely. I mean, the dollar over the long term is a weak currency block. We still have this twin deficit problem, right? Our economy's strong, and when our economy's strong, we bring in imports, right? So our trade deficit, arguably, is actually getting a little bit worse right now, which is a weak dollar story.
Just to wrap things up with you, Bob Dole, on the European equity story, it was actually pretty tough post-French election to get the kind of returns you would have expected outside of the FX trade, in the equity trade in Europe. The fundamentals were solid. Growth has really picked up. We haven't seen the multiple expansion that you might expect, and we haven't seen the equity returns you might expect either. Is it going to happen this year?
I think it will. Remember, prior to the election, things were pretty good in terms of returns, so maybe it was just a pause. I don't think it's an either-or. Back to your earlier question, is it the U.S. or non-U.S.?
Yeah.
I think it's all of the above. You've got to be in equities, and I think we will get that European bump this year.